there's basically a handful of different things that result in something being truly censorship resistant, centralized or not. Part of it is the whole proof of work versus proof of stake thing, but then it also comes down to the ease or difficulty of running a full node. Another thing that came up recently regarding Ethereum's design is that if it's hard to run a node, if there's low percentages of running nodes, which is technically true for both ecosystems. Not many people run nodes, but it's much less so in Ethereum because it's much harder to run a node, and so they rely on these external node infrastructure providers that are in the cloud, and then can just censor whatever they want. And so for anyone other than a power user, Ethereum's already essentially centralized, and the threshold for being a power user is higher in Ethereum than in Bitcoin, and I think that that divide's probably going to grow over time. I mean, you can imagine 10 years of this. How more complex would it be to run an Ethereum node than a Bitcoin node? So there's that aspect, and then there's also if the blockchain is inherently designed to do something else. So Bitcoin is inherently designed to be pretty much self-referential. You can build things on top of Bitcoin, but the primary purpose is not to do that. Whereas in Ethereum and smart contract platforms, and I have steelmanned the reason for their existence. I've done that in a number of pieces, both my Ethereum piece and then my proof of stake piece. So I've kind of explored, steelmans for why smart contracts are useful. But if the hard money blockchain is also inherently a smart contract blockchain, I think you have kind of a fundamental divergence because you open it to be capturable in various ways. You open up the stablecoin centralization problem, where one or two stablecoin custodians can effectively determine the outcome of hard forks by breaking the DeFi, whatever side they don't pick. And number two, you introduced minor extracted value or maximal extracted value, which is just inherently more centralizing and complex. And I haven't gone down that rabbit hole to the same degree that, say, Alex B has or Nick Carter has. There are people that have really, dived into that, but I understand it enough to see how centralizing it is. And so I think the fundamental issues are not just proof of work versus proof of stake, and it's one of 3 or 4 different issues. One thing I observed when looking at the history of Ethereum is that you generally started from a position that was not hard money, and then on the surface tried to harden it, not by actually hardening it, like not doing things like removing the difficulty bomb and things like that actually make it immutable, but instead trying to make it more deflationary and basically equivalenting deflationary or disinflationary with hardness, which is not quite the same thing. Because, for example, Apple stock is an outright deflationary unit, right? So it buys back more shares than it issues. And so if you look at Apple's shares, for example, they've gone down from 26 billion to 16 billion over the past 10 years or something like that. And so, but no one would call that sound money, because the key thing is that they always have the option to change the number of shares if they really needed to for some reason or another. And so with Ethereum, you've started from a position where you had higher issuance, and then they made decisions to reduce issuance, and then they do EIP 1559. We're basically in some ways purposely making the protocol less efficient in order to burn more ETH. And that works up until you start to get kind of market share dilution of smaller users going to other blockchains. So you see, for example, people that want to transact in stablecoins outside of DeFi, if they're actually, say, in Argentina and they want to hold some stablecoins as like near-term savings, they'll often use Tron rather than use Ethereum in order to save on fees. You see some DeFi spilled over onto Solana, Avalanche, other platforms. Unfortunately, Luna as well. So you have that kind of spillover effect. That's stalled now that it's in a bear market and fees are lower. There's less of a reason to spill over. But if you were to hypothetically get another raging bull market in a high fee environment, you probably would see more dilution. Whereas with Bitcoin, they've gone in the opposite direction, where they started super hard and immutable, and then all of the soft forks they do are to try to make it more efficient, right? So SegWit, basically reduced fee pressure. Taproot can also reduce some fee pressure, And the reason I'm not that worried about Bitcoin eventually getting a fee market is because the block space is inherently limited. And so if adoption goes up 5x or 10x over the next 10, 20 years, you'd expect a pretty high fee market. Now, if Bitcoin does not ever develop a substantial fee market, that inherently means that there's just not a lot of demand for block space, which I think is a bigger problem than just the fee issue. That probably would mean you had an adoption failure of some sort. So I think that in general, the concern trolling around Bitcoin's fee market, I think, is premature. If there's no fee market even emerging in like 7 years, by the end of this decade or something like that, I think those discussions become, more credible. But in this early phase, especially because Bitcoin is inherently a lower velocity type of asset compared to a smart contract chain, I think that it's just, I don't think that's the main reason they did the switch. I think that's something that they use to try to make, strengthen their argument, but I don't think it's actually the catalyst. One thing I'm kind of watching for, probably by the beginning of next year, maybe, is when the Fed is done with its hiking cycle. And in a vacuum, risk assets can certainly do well when you have the Fed hiking, right? So the whole 2017 Bitcoin bull market, and that was a stock market bull market as well, the Fed was hiking rates that entire year, and all those risk assets kept going up because normally the Fed is hiking in a kind of a strong economy, right? That's when they're usually putting the brakes on, is because things are kind of booming, and then they're kind of trying to dial that back a little bit. Whereas what we have in this environment is that they're trying to hike into economic deceleration because of the supply side problem. And so it's a very different dynamic than what we normally see in a Fed tightening cycle. And so I think the key comes down to basically seeing how far they can get. I think the 2 years are already giving us some indication of how far they're going to get, which is, a little further than they are now, but probably not way further, before we start to see more recessionary-like conditions materialize. So kind of what I'm watching for is that potential, pause or pivot or capitulation. And I think it's not here yet, but it's something I have on my radar. And until then, I've just, I'm positioned diversified to be able to kind of withstand the shocks that we're going to see along the way.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video, link is in the description. Thank you.